plunged 2.4%, well below forecasts of...
Money continues to disappear from investors by the billions.
Today, the sell-off continues. The Dow plunging to lows not seen in 2 years.
The outlook was bleak. The economy was still reeling from the dot-com bust. And what the country needed was for Americans to start spending. Alan Greenspan made that easier. As Fed chairman, he controlled the country's short-term interest rates. The lower the interest rate, the cheaper it was for people to borrow money. 5 days after viewing the devastation at ground zero, Greenspan began a series of sharp cuts in interest rates. Meanwhile, the president went on television, exhorting Americans to keep the economy afloat and go out and shop.
We cannot let the terrorists achieve the objective of frightening our nation to the point where we don't conduct business, where people don't shop.
Within months, the cost of borrowing money became cheaper than it had been in a generation, and Americans took notice.
If there is a bright side to the hit this economy is taking, it's that with the Federal Reserve cutting prime interest rates, it's prime time to get a good rate on a mortgage.
This week, 30-year fixed-rate mortgages dropped to the lowest level since 1971. Mortgage rates are falling.
Mortgage rates. Mortgage. Mortgage.
Mortgage.
Mortgage. Mortgage. Mortgage. Mortgage. Mortgage. Mortgage. Mortgage. Mortgage.
Mortgage.
The news of plummeting mortgage rates reached here, the cow fields of the Inland Empire in Southern California, where Joe and Barbara Dunkley, a chiropractor and a real estate agent with 4 kids and a good credit rating, decided it was time to buy.
When we did come out here and buy, our family thought we were nuts just because there were cow pastures everywhere. It stank so bad. I remember there were flies where the roof of the house looked almost black. There were so many flies.
You had to have some hope for the future.
You really had to have a vision to come move in back then.
The Dunkleys' dream house cost them a little more than $300,000. Lower interest rates had made buying more appealing, but the downside was that prices were rising faster than people's incomes.
Housing prices, just how high can they go?
Real estate is red hot. Good news for sellers, but making it even tougher for buyers.
Housing prices are very high, and they've grown much faster than incomes.
The worry is that if prices keep rising much faster than income, fewer people will be able to buy, slowing demand and causing prices to fall.
But back in the Inland Empire, demand didn't slow, nor did the prices.
We bought it in January, moved in June, and had $100,000 in equity before we even moved into the door. That's how quickly the prices just started to go up. People were giddy, you know. We looked really smart.
It's the American dream, you know, the white picket fence, the yard, the kids. It's almost cliche. You want a home that you can raise your family in, and you swing for the fences and you wait for someone to tell you you can't have it.
Prices kept rising. And for the millions of Americans who wanted in on the dream, it was tougher to afford. So a few hundred miles away from the Inland Empire on the California coast, veterans of the mortgage business were thinking up new ways to make sure no one was told, you can't have it. When we return, banks decide the perfect mortgage candidate is anyone with a pulse.
You can be an insolvent arsonist, and it doesn't matter.
That's next when House of Cards continue. It's morning in Orange County, California, home to Desperate Housewives and Disneyland, and birthplace of the subprime mortgage, a mortgage for the credit challenged. Here, it's all about making dreams come true.
It was all here.
Everything. This is the pulse of the subprime industry, the nerve center. This whole area, every major company, Option One, New Century, Quick Loan Funding, this is where it all started, and this is where it all ended.
Lou Pacific got his start in the mortgage business soon after he returned from serving in Vietnam. Back then, getting a mortgage wasn't easy.
You had to have a job, money. The underwriters back then used to literally come out to your job to interview at your job. They would go to your bank, to verify that you had money in the bank. That's why it used to take 90 days or more to do a loan.
Just ask a mortgage lender what it used to be like.
A fully documented loan, which is, if I want to do your loan today, I got to shake you down and check
my tax
I
returns.
want your 2 years tax returns. I want to know how many times you've been married. I want to know what your obligations are. I'm going to basically ascertain everything about you to decide if you can pay.
Bill Dallas founded 2 major mortgage companies during his 30 years in the business.
Our industry at its heart is a people industry. It's labor intensive. It's customer relationships at the front. And it's been driven by small and medium-sized mortgage bankers that deal with Fannie and Freddie.
Fannie is Fannie Mae. Freddie is Freddie Mac. Nicknames for 2 companies created by Congress to increase home ownership. The way they do that is by actually buying home loans, scores of them, from mortgage lenders. It's a great deal for the lenders, who get cash in return and can make more loans to more people.
For Fannie and Freddie, owning mortgages is a good deal. They receive the constant flow of monthly payments from homeowners. Each of the companies then pools the money that comes in from the mortgages and sells shares in that pool. The result? An investment called the mortgage-backed security that big institutions like pension funds learned to love. For years, Fannie and Freddie dominated the multi-trillion-dollar market for mortgage-backed securities. That influence allowed them to dictate the terms of the mortgages they would buy.
We were used to being led by Fannie and Freddie, so we got all of our rules from those guys, and that's what we did.
Their rules were strict. Fannie and Freddie only bought mortgages of homeowners who were likely to make their monthly payments. That kept a lot of people locked out of their dream. Some couldn't afford a down payment. Others had lousy credit. But the new mortgage lenders in California wanted to change all that. They wanted a chance to offer anyone a mortgage. And they saw their opportunity when Fannie and Freddie became entangled in accounting scandals and lost their dominance of the mortgage market.
When you look at an industry that was driven by Fannie Mae and Freddie Mac for almost 2 decades, suddenly you don't have the leaders of the industry even around. They're in the penalty box. We thought that was a huge opportunity to do some of the things that we wanted to do, which is change the rules.
All Bill Dallas needed was someone to take Fannie and Freddie's place. Someone with huge amounts of cash who'd be more willing to bend the rules.
Who took over? Wall Street.
It was just the opportunity, quote-unquote, opportunity of a lifetime for Wall Street to get in.
Michael Francis spent years at a major Wall Street firm that ramped up its business in mortgage-backed securities, drooling over the prospect of replacing Fannie and Freddie. He asked us not to reveal which firm for fear of incurring its wrath, but we can say he was in the right place at the right time.
It was a good couple of years before it really started to ramp up. Very, very small volume until sometime after the end of 2001, 2002. And it just caught fire.
The mortgage market caught fire because the world was flush with cash. Countries like China and India that used to be poor had become rich. Petrodollars were pouring into the oil-producing countries of the Middle East and Central Asia. They foraged for safe investments that offered hefty returns, and Wall Street had just what they were looking for. Securities backed by American homes and American borrowers. To feed the demand, Wall Street bankers like Michael Francis enlisted lenders on the West Coast to supply them with more mortgages.
Mortgage originators are on the ground, beating the pavement trying to get loans to make money. They are naturally going to come up with a lot of different ideas on how they could generate more revenue through more loan volume. So we would reach out to those folks to help us.
The moment the mortgage originator sort of met an unregulated Wall Street, those are 2 wires you don't want to cross.
But that didn't stop Bill Dallas. He convinced Wall Street banks to buy up his mortgages. Mortgages given to borrowers who weren't quite prime, but weren't the bottom of the barrel either.